Thank you for joining us for another lesson here of accounting for non-accountants. In this lecture, what we're going to be starting into is the liabilities section on the balance sheet. So in our prior lessons, we took a look at the asset section. So now we're taking a look at the other side of the basic accounting equation, taking a look at the liabilities. Okay, so in general, a liability is basically any outstanding debt that the organization is obligated to pay. Okay, so this, commonly comes in form of a note payable or a standard accounts payable. So remember the liabilities. They're an important element of the basic accounting equation, where the assets of the organization is going to be equal to in value to the sum of all the liabilities plus the equity that's been put into the company. Okay, so looking here with this equation, it kind of helps you to remember that anytime that we're going to increase the asset position of the company, that also has to come in the form of increasing a liability or the equity position, or it could also come in the form of decreasing another asset. Okay, so taking a look at some examples here. One, if say we're acquiring some machinery, okay, so machinery and equipment, that's a form of a fixed asset. So if we were going to buy a new piece of equipment, we would debit that account, and we could book an offsetting credit to a note payable or a standard account payable. Okay, so when we credit the liability, remember that is what increases the liabilities. Assets are increased by the way of a debit to the account, whereby liabilities are increased by way of a credit to the account. All right. Now another example of, in this case, purchasing IT equipment. Say we bought a new server for the company, we would go ahead and debit that asset account to increase that asset position on our books. And in this case, say if we just paid cash for the server, cash is an asset, so we would go ahead and credit the cash in this case. Okay. So next here, let's start off by talking about current liabilities. So current liabilities are all debts that the organization anticipates retiring within the course of the year. Okay, and many of the current liabilities are actually retired in a much shorter time frame. So common examples of current liabilities would include accounts payable, accrued inventory, accrued expenses, sales tax liabilities, and also there can be accounts set up for the current portion of the long-term debt that's outstanding for the organization. All right. So accounts payable, that's one of the primary current liabilities that you'll see on the balance sheet. And that, for many organizations, for most organizations, this particular liability is very closely managed. Usually there's a dedicated department with a manager to manage this accounts balance. And they just manage it on a daily basis. One important report that's utilized by the accounts payable department is the age payable report. And basically, much like what we saw with the age receivables report for accounts receivable, the age payables report is very similar to that in nature. Basically, it's going to be a report that subtotals all liabilities that we have due to our vendors and our suppliers. Reflecting all the open invoices and maybe open credit memos that are on the account. And it also typically breaks the activity out by aging bucket. Okay, so you'll have, your current invoices, then you'll have invoices that are 1 to 30 days past due, another column for the 31 to 60 days past due, then it extends progressively out beyond that. Okay, so what you'll see is that for most large organizations, they'll have an established credit line with their vendors. Basically, the credit line is a grace period that the organization has to make, time frame that the organization has to make payment. And it can vary from industry to industry, but one very common payment term that's offered is a net 30 days term. Okay, so if I send you an invoice on the first of the month, then my expectation is that that invoice in part should be paid by the 30th or the 31st of that same month. Okay. All right, another important current liability are accruals. And accruals, they're important. Basically, they are the entries that are made to basically recognize your debts in the period in which they were incurred, even if you haven't received an invoice for those debts or executed a payment against them yet. Okay, so let's kind of walk through an example here of accrued expenses. So let's say, for instance, that your company, they go ahead and purchase some shop supplies from a vendor, and those supplies are valued at $200. Okay, so these supplies, they are in part received at your facility, say on the last day of May's accounting period. All right, and the vendor, they don't get around to sending you out an invoice until June's accounting period. Sometimes there can be a day delta between the time in which the goods are shipped and the time in which the invoices are issued by the accounting department. Then you couple that with maybe a day or two transit time for the invoice in the mail. So you can have these types of situations. The receipt of the service or the receipt of the good is executed in one accounting period, but the bill isn't registered into the following. Okay. So in this case, we didn't get the invoice in May, but we did take title to those goods in May. So we need to go ahead and recognize that expense and the liability in the May accounting period. Okay, so in this case, the accounting department will oftentimes check with the purchasing department, or they might have a report that they can run out of their accounting system that will show them all the receipts that have been executed for which we haven't got an invoice yet. So in that case, they would go ahead and book a journal entry in accordance with that, debiting your supplies expense account for $200, and then in part booking an offsetting credit to the accrued liability account for $200. All right. So then June's accounting period rolls around. We go ahead and get that invoice from our supplier entered into the system. Then in that case, we would go ahead and debit that accrued expenses account for $200, basically clearing out that balance, and then booking a credit to the accounts payable account for $200, all right, which would be the account against which we would actually issue payment to the supplier. All right. So you can see in this last entry here, really no additional expenses are being realized, but we're just in part transferring the charges from one liability account to the next. All right. One more accrual account to take to walk you through another example would be your accrued payroll account. All right. So, for many organizations, their payroll might be set up to pay out their employees every other week, or maybe pay their employees every 15 days. So, the result of this is that, a payroll period can span over 2 accounting periods. All right. So in this case, when this happens, what we want to do is to match, at the end of the month, we want to go ahead and match up, the payroll expenses that were realized in that accounting period, okay, before, the month end cutoff. Okay, so let's say by way of example that when we go and execute a payroll, we are going to book, $2,000 against the wages account. we're going to book $15,000 against the salaries account. And we're also going to incur $2,500 worth of payroll tax expenses. All right. And with this example, let's assume that the month-end cutoff, it falls in basically at 3 days into the payroll period. So in this case, what we want to do is, say if the payroll, we get paid every 2 weeks, so that's a total of 14 days. So basically, we want to realize the expenses of 3 out of the 14, or 21% of the expenses need to be booked in this accrual. So this would be what the journal entry would look like. So 21% of the wages, of the $20,000 of wages, would be $4,200. So we debit that. We would debit the salaries account for $3,150 because that's 21% of the 15 grand, and the payroll taxes would be payroll tax expense would be debited for $525, and that would all be offset to a credit in the accrued payroll of $7,875. All right. So then in the following month, when we actually go and issue out the payroll to the employees, this is what the journal entry would look like. We would book a debit to clear out that accrual that was made to the accrued payroll account for the $7,875. Then we would recognize the balance of the expenses in the wages, salaries, and the payroll tax accounts. And that would all be offset with a credit to a cash account, or some type of payroll account that you have set up at your bank. All right. So that's how the accrued payroll can flow through. All right. So one final thing that I want you to be aware of is in accounting, there's a lot of useful ratios that you have. And one important ratio, they call it the current ratio. And basically what we're doing with the current ratio is we're weighing the total current assets of the organization versus the total current liabilities. Okay, so if you have a lot of current assets versus a little amount of current liabilities, your current ratio is going to be very good. Okay, so but if the opposite holds true, if you have a low amount of current assets versus your current liabilities, that's an indication of a poor current ratio. So again, I think this is something that probably varies from industry to industry, but for some of the businesses that I've worked at, a current ratio of 2 or higher is considered to be favorable, and a current ratio of less than 1 would be something that would be concerning. All right. So the current ratio, it's basically, your organization's ability to retire its short-term debts. The organization needs to have cash to retire its debts. So, in the current assets, you're looking at the cash that you have on hand, as well as those assets that you can readily convert into cash, those being the accounts receivable and the inventory. Okay. So that concludes our lesson here for today. I hope this was of help to you, and if it was, I would ask you to please like and subscribe. And as always, if you have any questions, you can feel free to inbox me. Thanks a lot.